Hello, everyone. Today on the final bar, we'll do our normal Friday routine, wrapping the week, focusing on how the pictures have changed over the last 5 trading days. The S&P pushing ever and ever upward, closing around 4230. That's up almost 1% and continuing to threaten new all-time highs, pushing to the upper end of its recent range. Overall growth back in the driver's seat. The FAANG stock's doing just fine. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets through the lens of technical analysis and focus on the message the markets provide through price. Price should reflect all information, or so the theory goes. John Murphy, in his book on technical analysis, early on, the first book I read on the practice, reminded me that price is a representation of the collective psychology of investors. And sticking to that theme alone has served me very, very well over my career. And I think if you focus on price, especially in an environment like this, where you have lots of movement, you have stocks that are working and stocks that are not, assets that are working and assets that are not, price can tell you where to be focusing your attention. When in doubt, follow price. Now, we have a great schedule coming up for you. Recently this week, we had 2 great guests, Dave Landry on Wednesday. We had Craig Johnson on Thursday, both really knowledgeable and enjoyed picking their brains on what they're seeing. Next week, more of the same. On the 8th, on Tuesday, we have Jesse Felder from the Felder Report. On Wednesday, the 9th, Javed Mirza from Canaccord Genuity in Toronto. And then on Thursday, the 10th, Sam Burns from Mill Street Research in Boston. Also wanted to announce I'll be doing my next free webcast with market misbehavior coming up Tuesday, June 15th at 1 o'clock Eastern. It's called Demystifying Fibonacci. We're going to talk about Fibonacci retracements, break down how they are derived, why they are useful, and we'll go through a bunch of examples, including Bitcoin, stocks like Tesla and Facebook and others. So join me for that free event. If you're interested, go to marketmisbehavior.com/Fibonacci. Let's go on to our Wrap the Week segment. This is where we focus on how the picture has evolved over the last 7 days, over the last 5 trading days or 4 trading days with the shortened holiday week. I want to start with a poll, though. We asked you recently, which of these would you rather own over the next 3 months? Consumer discretionary, consumer staples, or cash? I'm struck when I look at the results, to be honest with you, how evenly matched they all are. Consumer discretionary narrowly edging out the other two with 40% respondents. 34% of you said you'd rather be in cash than either of the 2 consumer sectors, and 26% of you said XLP, consumer staples. It's an interesting question because I tend to think of it as a binary outcome, thinking of, do I want to be in the strength of consumer discretionary or the weakness? And a better way to say that is the offense of consumer discretionary or the defense of consumer staples. But remember, there's that third option, which is neither, right? Going into cash. And it's interesting to me that a third of you said that cash would be the right answer. You'd rather be in no stocks between those two, but rather in cash. It'd be interesting to see, because that ratio, as we'll see here in a minute when we get to our the Mindful Investor Live chart list, that ratio is actually potentially breaking to new swing lows. It hasn't really made a new low since the February 2020 into March 2020 market high. That's the last time the ratio has broken down to the point where it's almost breaking down today. So we'll look at that here in a little bit. Let's continue on with our Wrap the Week segment. We'll start just looking at the S&P and some other major asset classes today. We're going to look at the weekly changes in all of those asset classes. Then we'll get to our Mindful Investor Live chart list to hit on the key themes from the week. So today was certainly about market strength. The S&P closing around 4230, up 0.9% from where we were on Thursday. The last couple of days have been more distributive. Today was anything but. Today was all about risk on, all about stocks going higher. And not to jump too far to the conclusion here, but we're at a new closing high. I don't think we quite made it. We're really, really close to the high from early May, but we're certainly right knocking on the door. And so I think The key with the S&P is we are testing the upper end of this range. My question would be, do we have enough momentum going into next week, enough demand or enough buying power to push the S&P further to new highs? It's worth noting, by the way, that the S&P is testing a new all-time high, while the momentum is much lower than it was last time we were here. Every time the S&P has pushed higher in the last 2 months, the momentum has been lessening and lessening. Now, what you may answer is, isn't that what happened back here in January, February? And absolutely. I remember talking about this chart a great deal, talking about the warning signs of the market moving higher on lower momentum. That was invalidated by the way we finally made new highs and the momentum broke out. And that breakout in late March is what really, I think, changed any minds. If you were bearish, I think you had to acknowledge that we had gone on to new highs. We're in a similar sort of pattern that we were sort of back here, sort of in mid-March. And so the question is, do we resolve like we did that time, which was a brief pullback to the 50-day before a rotation higher, or have we exhausted the uptrend? Only the chart itself is going to tell us which answer is correct. Very quickly, mid caps and small caps lagging. So this is very much the mega cap sort of FAANG stocks that were pushing higher. The VIX is back below 17, almost to 1650, and the NASDAQ 100 outperformed pretty much everything else. Bonds are back in an uptrend, at least on the tactical time frame. We're going to look at a chart of the TLT here in a little bit, but testing that 140 level, which has been resistance in for quite a while. 10-year yields back lower, below 160 for the first time in quite a while. Gold and silver, though, working just fine. So if you think of gold and silver, or especially gold, as sort of the safe haven, a risk-off play to get away from stocks, that's not the case. I'd say we are seeing a risk-off moves with cryptocurrencies, which continue to deteriorate. We've talked about the weakness in Bitcoin. We looked at that chart of Bitcoin. I still think we're going to see lower, lower prices than we're at right now, right around 37,000. And I think checking the Fibonacci retracements on the chart of Bitcoin could serve you pretty well. Very quickly, just today, as a reminder, tech, communication services, consumer discretionary, the top three sectors, far outpacing pretty much everything else. The cyclical leadership we've been talking about was really sort of mid-range relative to the S&P underperforming a little bit. And then on the downside are really the defensive plays like utilities and real estate, certainly underperforming during the course of the day today. Let's look at how the week evolved. We'll update this chart. If you follow along with my voice and the cursor, you'll see what is what, but the S&P 500 is right here in black. I have to update this chart. I'm just realizing it because we're taking in just a little too much data here. Let's do 4 days because we had the holiday, and we'll take it from last Friday. We skip Monday, and here we go. All right, so looking at the 4-day returns here since last Friday, we have the S&P up 0.6% really. What underperformed the S&P this week? The NASDAQ 100 up 0.5%. The US dollar is actually flat, up about 0.1%. It's interesting, though, if you look at the dollar index, it certainly bounced off of some fairly weak levels. That continuation of an uptrend would be a very different scenario than we've seen. This is at a time when things like India, Brazil making new highs, China not quite. China's more range bound, but interesting to see. And out of all of these, gold actually the worst of the bunch, down 0.7% when most other asset classes were positive. What outperformed stocks in this shortened week? In purple, we have small caps up 0.9%. That's the Russell 2000 ETF. In red, we have bond prices up 1.2%. So this is a week which we've not seen often, where bonds actually outperforming stocks, and that stock to bond ratio has essentially been sideways recently. Also outperforming stocks, we have emerging markets up 2%. We have crude oil, the best of the bunch, using up 4.1%. That's using the USO, by the way. And if we go back, this is going to include Bitcoin. I need to shorten this up to a 4-day return here very quickly. And if you see, Bitcoin actually was outperforming. It was actually the best up until today, and actually undercutting crude oil here for the week, still up 3.5%. But this day is what we're seeing on the charts, where things are rolling over very, very quickly. So overall, sort of mixed, right? You can see the S&P in the middle, something's underperforming, something's outperforming. But really, it was the bonds, I think, are the big surprise in terms of moving higher this week on a relative basis. And EM and crude oil, not much of a surprise there, I think, continuing their recent uptrends. We're going to finish off our Wrap the Week segment looking at the Mindful Investor Live chart list. We look at this every Friday. If you've not seen the show on a Friday before, You can access this list if you're a StockCharts member, no problem. Go to your dashboard. You're going to see all of your chart lists. That's actually not right. Sorry. Click on the articles tab. Click on the articles tab. Go to my blog, which is called The Mindful Investor, and you will have a link at the top of that page to get to this live chart list. I update it about once a week in preparation for the show, but you're welcome to take those charts and save them, do whatever you want with them. We start with the market trend model. This we update every Friday at the close. No change from last Friday's signals, where you have the long-term model remaining bullish, and I would expect that to continue because you would need a huge pullback to actually register a sell signal on the long-term model. The medium-term model actually turned negative 3 weeks ago, and for me, what that basically says, the market can go higher, which is what we're seeing today. What it tells me is to be thinking more about risk and less about reward, right? Think more about stocks that you're holding, positions that you have, and look at what lines in the sand you'd want to focus on. This tells you to be thinking, put your risk off hat on, and it doesn't mean to sell things just because. It tells you to focus more on where stocks are relative to support levels. And I would say with certain stocks, things like Tesla, for example, I think they've broken support and would indicate that you need to be defensive there. But certain stocks, obviously breaking new highs. Facebook, what I would call the FAANG stocks: Facebook, Alphabet, Microsoft, eBay, all at or near new all-time highs. So those are charts that are just fine. I don't think there'd be reason to sell those based on this model. What the model tells me is to be more cautious and skeptical. The short-term model, by the way, has remained positive. It just narrowly turned negative about 3 weeks ago, but turned right back positive, and overall has remained positive since February. So what you have is the long-term secular trend is positive. That makes sense with where we're at in the cycle. The medium-term trend is negative, and what that basically does is recognize the sideways move that we've been in. If you missed my show yesterday, I had a great conversation with Craig Johnson about the three directions of the market. Any market can go up, it can go down, it can go sideways. We talked a little bit about that environment and what it might mean. The short-term model is positive, and again, we've reverted back higher, making new all-time highs. So that model is pretty much how I would interpret the chart. We talked about the daily chart of the S&P. I don't mean to beat it any more than that, but obviously we're making a new swing high here and breaking above, closing at a high for the week, which is all impressive. I think we're still right at the high from early May. So I don't think we've had a clear indication that things are all clear. Next week, that's absolutely what I would be looking for, right as the RSI gets above 60 for the first time since early May, when we were at this level once before. Do we have enough momentum to push the S&P on to further highs? And if so, and most importantly for me, if that would push the medium-term trend model back positive, that would signal an all clear for stocks. We haven't had it yet in my view. I tell you where things are pretty decent is with breadth picture. I'm not seeing a lot of concerns on breadth measures that I follow. The cumulative advanced decline line across the board, large cap, mid cap, small caps, all making a new all-time high in the last week. That's a constructive pattern, right? That is overall a thumbs up in the clear sort of trend characteristic or breadth characteristic. If you would see the market go higher and not being confirmed by these advanced decline lines, then it would be cause for concern. You're not seeing that. You're seeing these all making new highs, which is supportive. This week on I think this was Tuesday or Wednesday, wherever this was about 16% of the S&P, 15 to 16% of the S&P making a new 52-week high, which is pretty good. That's actually pretty healthy, and that's in line with previous bull market phases. I think what you're finding right now is you have a lot of stocks that are able to make new 52-week highs. Going to the next chart, this is how many stocks are above their 50-day moving average. And the concern I have right now is you have plenty of stocks making new highs. That's good. But if you compare where we're at right now versus where we were 6 weeks ago, we had 92% of the S&P above their 50-day moving average. Right now, it's more 71%. It might be a little higher after today's close, to be honest with you. But overall, it's in the low 70s. So that's about 20% of S&P stocks that were above their 50-day moving average in April and are no longer above their 50-day moving average. So while the S&P remained above its 50-day and kept rotating higher, a lot of stocks did not. And these are sort of the Tesla, ARK Innovation Fund types of names that are still below their 50-day moving average. So those have not participated in this upswing. This has been led more by other things like energy, which have raged higher. Today, it's follow through on some of the larger cap, mega cap tech and communication names, but it's not some of those other names. And that 20% of stocks is a bit of a concern. With the S&Ps going higher and less stocks are above their 50-day, that tells you that's a smaller group of names that are still going higher. That is a stretch to find a negative indication for breadth, because again, it's still 71% of stocks above their 50-day. That's still bullish, right? As long as you were made above 50%, that indication, all else being equal, is bullish. We talked about sentiment yesterday, so I don't want to talk too much about it, but AAII survey finally jumping a little bit higher, up from last week, which is in the 30s, back above 40% bulls. Until we get to about 50% bulls, I think that's still relatively stable of a reading. The name exposure index has continued to increase. So that shows you in the last 2 weeks, you've gone from about 43% to about 83% of money managers or exposure to equities by money managers, which is an increase. So certainly you're seeing some buy-in. Where you absolutely have had a lot of buy-in is on the RIDEX flows. And that's actually one of the lowest readings, if not the lowest reading in the history of the series, going back for decades. That should suggest that anecdotally, the last buyer is in, right? The individual investor is fully committed to this market. We'll have to leave it here, but I just want to quickly mention, we talk about offense versus defense in consumer. This is the chart that I was alluding to. You know, if you look at the ratio of the two on a cap-weighted basis and on an equal-weighted basis, we haven't quite broken down, but we're really, really close. That breakdown would be the first time you really had a breakdown in these ratios since back here, since March of 2020, really February of 2020, when they rolled over and really accelerated out of the market top. So this is sort of an indication within consumer that investors are stepping away from the offensive consumer discretionary into the defense of consumer staples. That's our Wrap the Week segment. We'll take a quick break, back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to have you join us every weekday after the close for our show. As a reminder, we'll do another mailbag segment here in a few moments. I would love to hear from you and answer one of your questions in our next mailbag segment, which will be on Tuesday's show of next week. You can email us any questions that are coming up as you are analyzing your own charts, things you're hearing about, having talked about, or being talked about in articles, online, on financial media, whatever it is. We'd love to answer your questions. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. Finally, on our YouTube channel, just put a comment below the video that you're watching. We'd love to answer your question next week. Also, as a reminder, go to stockchartstv.com and join thousands of others who have created a free account using their email and start watching all of our great content on demand. We have a fantastic suite of hosts. I can't tell you, speak highly enough of all the great work that some others are doing on the channel. You can see it all on StockCharts TV on demand. Go to our website, or we're on all the app stores. Just search for StockCharts TV on demand. Let's continue on with today's show with the Final Bar mailbag. As I mentioned, you can email us your questions anytime. These are all questions that we received in the last day or two, and I thought would be great to share with you on the show. Let's get started. Question basically, how much have chart patterns changed since you read the Bible on charts by McGee? You're talking about the Edwards and McGee book, which is one of my analysts, my former analyst at Fidelity, used to reread that book every year, and just sort of his way of staying true to the discipline and making sure that you're focused on price and trend in an appropriate way. That was one of the first books I read after the John Murphy book. I think the second one was the Edwards and McGee book on technical analysis, really focusing on chart patterns for stocks. But it talks a lot about support and resistance, about trend lines. So how much have things changed? You're crediting me by thinking I remember all the details of the Edwards and McGee book this much, because I have not read it in a couple of years. What I would say, though, the one thing that's changed a lot about chart patterns, and I forget how much Edwards and McGee went into this, but I think they did, was the use of volume. So if you look at something like a head and shoulders pattern, to be considered a true head and shoulders pattern, a purist would say you also have to look at the volume picture. You can't just look at the price and conclude that something is a head and shoulders pattern, it also has a volume component. And you want to look through the course of a pattern. You want lessening volume as the pattern goes on. And then once the pattern breaks out, you want it to be on heavier volume. And that volume and price relationship was very important to a lot. And I'm fairly certain that's gone into in some detail in Edwards and McGee. If you look at my work, I rarely mention volume. Craig Johnson mentioned it yesterday on the show. I rarely bring it up. And that just comes from over time. When I was first learning technical analysis, I looked at volume all the time because I was reading those kind of books and John Murphy and others that talked about the importance of volume. I found volume to become less and less reliable because I think volume now means something very different than it did 50 years ago. Then it was a directional bet and you could look at price data versus volume and you could make a very clear distinction about what was happening. Now I think volume can mean a lot of different things, and you think about all the different dark pools and decimalization and all of those things, I think have impacted what the volume reading actually tells you. So I pay less and less attention to volume during patterns, which is probably the biggest change that I think the market has done since Edwards and McGee's incredible work. I still think it is absolutely worth reading if you have not done so. Next question. This is about the RRG chart. So I'll bring that up as I'm reading it here, but let's see. I don't understand why sectors like XLB, XLE, and XLI are in the lower quadrant when their charts are way above the 50 and 200-day moving average. Plus, they all had a great day today. This was yesterday, the day before that you wrote this. And you're referring to the fact I think that you have those sectors sort of down in the weakening quadrant. How can that be when they're doing so well? And that's the daily one. We can look at the weekly one and see if that is maybe what you're. Yeah. See, I think you're more looking at this one here, the daily RRG, the weekly RRG. We're seeing the energy and materials sort of down in this area. What's interesting is since you wrote the question, they're actually rotating higher a little bit, which is kind of interesting. But how can they all be in the lower quadrant? So here's the thing: when you look at something like the XLE, which is here, it's not about the price, right? So the fact that the price is above the 50 and 200-day moving averages is great from a price perspective. The fact that the price is making new swing highs, that's all constructive if you're looking at price. But remember that the RRG is based purely on the relative strength. It's looking at the relative performance of energy versus other sectors. And it's not just looking at this line, it's derivatives of this line that Julius de Kempner created as a way of basically creating a rotational pattern using relative strength. So if you look, things like energy and others have actually been relatively sideways on a relative basis. So depending on what time frame you're looking at, even though they're above their 50 and 200-day moving averages, all the sectors are above their 200-day moving average, and most of them, if not all of them at this point, are back above their 50-day moving average. So that alone doesn't make it better than other sectors. And that's the beauty of the RRG, is it doesn't just tell you about the price, the absolute price return. It tells you about the relative strength, what sectors are doing better or worse than other sectors out there. So that is how those sectors can be in the lower quadrant when they're above their 50 and 200-day moving averages. I would encourage you to focus on the relative strength line. That'll probably make it a little more clear as to why they're there. Third one is not a question, but it was more a correction. We don't have a correction column on the show, but thanks someone for catching this one. I mentioned the GCC earlier the week, and we were talking about commodities breaking out. We're looking at this ETF, the GCC, and what you pointed out, which is what I completely missed. This used to be an equal weighted commodity index, but it's not anymore. At the end of last year, at the end of 2021, they actually reorganized the fund and changed it from being an equal weighted ETF. Used to follow the Thomson Reuters equal weighted continuous commodity index, and that CCI index is one that I'd followed for years and years. They actually unwound it from that index. It's not around anymore, I don't believe, or if so, it's not one that they use. And now it's turned into more of an actively managed commodity fund, where they're actually changing the weightings based on more of a qualitative process. It could be more of a quantitative process, to be honest, but it's more subjective than an objective equal weighted measure. So that's a great catch. Thanks so much for that. I will change my comment on that and point out it is not an equal weighted commodity index. But I would point out, if you look at the weightings in the GCC, and as you pointed out in your question, it still is underweighted to energy versus things like the CRB. So I think it still has value in that it's weighted differently, but it is not equal weighted. That's a great point. Last question probably here. My question relates to charts that don't have a clear signal. I looked at this chart in different time frames to mix messages, and this was the chart you were looking at, which is Village Supermarket. It's a small cap name, 300 some market cap, 300 million or so, VLGEA. Fundamentally, it's compelling, but I always get caught in value traps. Do you have an indicator for these situations? So, interesting question. So I would tell you this, the good thing if you're looking at equities is there's a benefit of the fact that sometimes the chart is just not compelling. We would always differentiate when you look at thousands of equity charts, you have to put them into buckets of what are actionable and what are not, right? And sometimes some charts just aren't really giving you a clear signal. I could make the argument that this is one of those. If you look at VLGEA, you can see that it had sort of a downtrend here from mid 2020 to make a low in early February, and then it bounced higher. Never really regained its previous high, and now it's not sold off really. It's really range bound. And if you look, it's sort of fluctuating between 25, 50, and 26 at the upper end. On the lower end, it's more 23.50 or so, right? And so we're in that consolidation pattern. So a couple comments that I would do. Number one, if you're looking at a chart like this, especially a higher yielding name, if you're going to look at support and resistance, I'd put the underscore in front of the ticker, because what that's going to do is strip out the dividend component to give you a pure read on the price. And if you're looking at support and resistance, that can be an effective way to make sure you're looking at the right stuff. Didn't change the picture a ton, to be honest here, but good thing to get in the habit of. Number two, this is a time when I would certainly use something like Fibonacci retracements. And again, I really have not looked at this chart until this moment, so I don't have any great opinions predetermined. I'm just looking at the chart fresh with you. So what I'm seeing here when I apply the Fibonacci retracements and take the low from March of 2020 and the high from July, which is really that big move higher, since then we've sort of settled into the range. And what's very interesting to me is we bottomed out just above that 61.8% retracement level, never got below there. We then traded back up, and now we found support a number of times right at that 38.2% level. So for me, as long as it holds around 23.50, which would be the price lows, and also is the 38.2% retracement, I think it's pretty good. I don't think your downside is too challenging. If you would break that, then that's where you'd look down to 21, which would be the next major support level. So that's your downside risk. Your upside potential really at this point is to 26, and you see if it's able to eclipse that, and then you could indicate a potential move to previous highs. So this is actually one where Fibonacci retracements can give you some good lines in the sand. And interestingly here, it lines up pretty well with things like the 200-day moving average, and previous support and resistance levels could be kind of interesting. We're out of time. The other thing I would maybe suggest is Bollinger Bands, because this looks like something that's had a big run and then has settled in. And what Bollinger Bands are really telling you about volatility, and this has had a narrowing of volatility, what it's probably going to tell you is not anything much different than what I had mentioned. And my overall conclusion is at some point, one of two things is going to happen. Either it breaks above 26 or it breaks below 23.50. That would be the trigger I would be waiting for at this point. I would be in wait and see mode on a chart like that. Great example of a chart that's not necessarily actionable, but giving you some ideas of where it would become actionable. I always talk about a trigger to look for. We need to wrap the show, go to the 3 and 3, 3 charts, 3 minutes. Here we go. Chart number one is looking at the New York FAANG Plus Index, $NYFANG. I just am recording a video for my own YouTube channel called Market Misbehavior a little earlier today. I'll post it later today, but we're actually going to focus on the FAANG stocks and introduce a new paradigm, which is called the FAME stocks. Instead of grouping all the FAANG stocks together, there are some within there like Facebook and others that are actually appreciated much more than others like Netflix and Amazon. The FAANG stocks are sideways, right? So even though you've had a nice run, we're still within a consolidation pattern, waiting to see if we break out of that pattern to the upside would indicate an all clear for sort of the growthy trade. The RSI is still below 60, by the way, on that chart. Chart number two is the long bond price. We didn't talk a lot about bonds, but I think this is at a pivotal moment. The TLT is testing 140, which was resistance in April and in early May. If we break above that, which coincides kind of with the 10-year yield around 150, maybe a little above that, a breakdown in yields, a breakdown in bond prices, the RSI getting above 60 would be a dramatic change in character for bonds. That could be an indication of more of a flight to safety, given uncertain future with stocks and anxiety, rising fear about what may happen next. But overall, I think from a technical perspective, just telling you the bonds are starting to work, and I've not said that phrase in quite a while. So breaking above 140 on the TLT would be an important line to look at. Another line in the sand I think is important is the FXI and the 48 level. It's the China ETF. You can see it bounced out of the oversold region. This is after a 50% retracement of the 2020 to 2021 early high. This has been actually a really good use of Fibonacci retracements. It's right at 50%. It's back above the 38.2%. I'm interested to see if the 200-day holds, or if we break above 48, which would be an all clear signal on China, which we've not had in a while. Folks, that is our show and a wrap for this week on the Final Bar. Keep your questions coming. We'd love to hear from you. Have a fantastic weekend. Until next week, I'm Dave Keller here at StockCharts.com. Be safe. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.